we figured it out. All right. So hi, my name is Scott Forehand. Welcome. It is Thursday, June the 9th. It's 5:30 p.m. We're here to do a debt-free life presentation. Then we're gonna have a little bit of a Q&A, and then we're gonna do a real live debt-free life illustration. So first off, what is debt-free life? So debt-free life is a play on words. It's also a trademark product offered through Symmetry Financial Group. And what it's designed to do is to turn debt, which is a negative asset, into a positive asset. And the goal here is to use whatever debt you have and whatever debt service you're making to keep that debt supported. We're going to use that against itself, eliminate that debt much faster than you ever thought possible. And then, oh, by the way, in the same process, we're going to create a tax-free retirement income stream for you. Or if you're doing these for business DFL programs, then we're going to create a private bank that you can use to borrow from that you never have to ask permission. It's yours. You can do with it what you want. So moving on, debt-free life. So when we first started doing debt-free life about 2018, 2019, there were a number of programs that were out there. And there's a lot of confusion when we first started. So let me first start by saying what debt-free life is not. It is not debt consolidation. It is not debt negotiation. We're not going to call your creditors and say, hey, look, I know I owe you $3,000. If I give you $2,000 today, can we call it even? That's not what we're going to do. We're also not going to destroy your credit score in the process. But the nice thing about it is, in the end, your credit score doesn't mean anything, because after the end, if you've structured these properly, you don't need credit anymore. You don't need to borrow money from a bank anymore. Anybody ever been in a situation where they needed to borrow money from a bank? What's the thing the bank doesn't want to do? They don't want to lend you money, right? Anybody ever been in a situation where you don't need any money from a bank? What's the first thing you want to do? They want to lend you money, right? So this gets us to the point where we can tell the banks to go pound sand. We don't need them. We don't want them. We've got our own private bank. And guess who the banker is, right? You get to make all the decisions. Hi, Tom Deutsch. Thank you for joining us. All right, so let's move on. So when we first are taught these programs, we're taught to ask a couple of simple questions. And of course, these are leading questions. Are you 100% sure you're going to have a great retirement? Nobody can really answer that. You think you've planned well, unless you're a financial advisor and you know, I mean, just know. And even then, you're probably still not knowing. There's probably that demon of doubt in the back of your head. You probably aren't certain. And the other question we ask, if we could show you a way to get out of debt in 9 years or less, including your mortgage, would you be interested in hearing what we have to say? The truth of that, and I've done thousands of these illustrations at this point, it's not 9 years or less. The truth is it's 15 to 27 years early is what it actually comes to. I've seen programs where it's not 9 years. I've gotten people out of debt in 2.3 years. And I've seen programs that have taken 15.7 years. And it's 15 to 27 years early is what I'm seeing for the most part. All right. But the whole idea here is that these two pieces, these two questions should resonate with everybody. And the questions, there should be no doubt in your mind as a consumer as to whether or not you want to listen to what we're getting ready to tell you. So let's move on. So if you are like most Americans, this is you. You make a fair amount of money, but most of your money is spent for interest and taxes. And this is the problem with America. We are taught from a very early age how to spend money, how to make some money, how to get into debt, but we're never taught out how to get out of debt. And if you think back, who are the people that are teaching us this stuff? And if you take a hard look at it, you're going to come down, it's the banks. And the banks in the banking industry teach us how to get into debt, teach us how to create some wealth, but not really. They teach us how to work for them is what it comes down to. So the whole idea here is that we want to change the game. We want to do things a little bit differently. We don't want this to be you, where 74 cents of every dollar you make is being spent for something else other than you. That 23%, that's lifestyle. That's not just lifestyle. That's paying your power bill, your gas bill, your Hulu bill. That's putting food on the table. That's maybe having some money left over to maybe take your kids to a theme park once a year or something like that. It's not a lot of money. And this is not the way our forefathers and the founding fathers of our country intended this to go. And that little sliver, that 3% savings, that's the real problem. The real problem is if anybody's paying attention to the markets and everybody understands where the baby boomers are and how they're all getting ready to retire, and how Walmart's going to have a huge influx of new employees. You're going to all be Walmart greeters because they're not going to be able to retire. That's the problem. The problem is we don't save enough money for retirement. So if you think about it, if I make $100,000 a year, which, you know, between 50 and 65 years old, those are the highest earning years of everybody in this country. If I'm making $100,000 a year, but I'm only saving 3% per year of my income as savings, how long is it going to last? And then, of course, that little demon in the back of your head says, well, I've got Social Security. Really? For how long? Right? They just came out with great new guidelines for Social Security. Ready? It's got one more year before it's going to be insolvent. They pushed it back 1 year, folks. You got till 2035 now. Great, right? And more importantly, when it doesn't go insolvent, why? It's because they're going to reduce the payout. So everybody who's going to be relying on Social Security is going to be in a bad way. And if the politicians, good luck, if the politicians ever can come together and figure out how to fix it, what's their only route? They're going to have to reduce what they're spending. Good luck with that. Or they're going to have to increase taxes. That's where this is going. So not only are the baby boomers going to get hit with reduced income coming from Social Security, they're going to get hit with increased taxes on top of that. It's going to be a whirlwind. And it's going to be a bad place to be. So where we are taught how to save at 3% per year is the problem. So where should that be? It should be much higher. Let's talk about that. So what our program decides to do or tries to do is put you in a situation where you're saving more for retirement, you're saving it more efficiently, we're spending money more efficiently, and we're actually turning debt on its head, making our debt work for us. The average American makes $2 million a year. $2 million in their lifetime. That's enough money if you save correctly. But looking at that 3% savings, you make $2 million. That last 15 years, you're making $75,000, $100,000 a year, but you've got $60,000 a year in savings beyond your Social Security. How long is it going to last? It's not. And that's the problem. We make plenty of money, we don't spend it correctly, and we don't save enough. So the whole idea of this Debt-Free Life program, which we're talking about, is actually using two separate and distinct financial instruments in conjunction with each other. Each in and of themselves, they work well, but when you put them together, the effect is not 1 + 1 = 2. The effect is 1 + 1 = 10. Okay, because they feed off of each other and they make each other grow. And I'll show you that in just a few minutes. And obviously that last question down at the bottom, this is not the American dream. This is not the way it was supposed to be. So where you are right now, and you go talk to a debt counselor, you talk to a debt consolidator, you go talk to somebody who purports themselves to be an expert on getting out of debt. If you're talking to those people and they're giving you those bullet point answers of what you should be doing, run away. Okay, work harder. How long can you work harder for? Spend less. Look, I ate tuna fish and ramen when I was in college. I have no desire to go back there again. Save more money. How can you save more money? Well, you got to spend less. So they're all revolving. It's a circular argument that doesn't end and is incorrect. Refinance. Wait a minute. Refinance my debt? Okay, what does that mean? That means I take all these little tiny debts and then spend more money to make all these little tiny debts. Refinancing doesn't work. It might save you a couple of points of interest, but it doesn't work. Consolidate. Wait a minute. So I'm going to take all these little tiny debts and make one big giant debt. That doesn't work. You're not making any headway. You're not doing anything. The only thing up there that works with regularity is a debt snowball. And that's only if you're doing a true debt snowball. So there's a gentleman out there who's been selling what he purports to be a debt snowball for a long time. His first name starts with a D, his last name ends in Ramsey. And I don't want to advertise for the gentleman. I like his concept. His thought is probably accurate, except the fact that what he teaches as a debt snowball is not a real debt snowball. What he's teaching is a debt stack. And when you compare debt stacks versus debt avalanches versus debt snowballs, there's only one that is always the best, and that's a debt snowball. And the other two will occasionally be equal, but they'll never be better than a true debt snowball. So I'm not going to get too much on my soapbox about that gentleman. So the better way, back to the 9 years or less question. Again, no, it's 15 to 27 years early. And if in the process of getting you out of debt 15 to 27 years early, I get to capture 60% of what you owe, whatever your principal owed debt is, if I can capture 60% as a tax-free retirement program for you, who's winning? All right, so let's move on. So where we want to go is where you are right now, from the left side of my screen to the right side of my screen. I want to change the way you're spending money on taxes from 40% down to 30%. So fast math, that's a 10% reduction. Real math, that's a 25% reduction in the amount of taxes you're paying. I want to change you from 34% of the amount of money you're spending on interest service, debt service, down to 22%. Fast math, that's a 12% reduction. Real math, that's over 40% reduction in what you're spending on interest. I know for a fact, if I set these programs up and you're paying money for it, I know for a fact if it costs you any more money than what you're spending right now, or doesn't relieve some of the pain that you're feeling right now, that you're not going to stick with the program longer. Which is why when we design these programs, our goal is to change you from where you are at 23% of your money being available for your lifestyle to 33%. Again, over a 30% increase. So let me ask you this. If right now you have, let's say, $1,000 a month left over at the end of every month in your income, what's left over in your checking account. If simply by executing one of these programs, we can change that from $1,000 to $1,300 a month, which is an additional $3,600 a year. What does that mean? That means you're taking that cruise. That means you're taking the kids twice a year to Walt Disney World. That means you're buying that extra, that new snowmobile. That means you're buying that brand new fishing rod for your boat, whatever. It gives you money to live on. And it gives you a place where you can be happy and proud, and you can see the light at the end of the tunnel, and you don't feel this crushing debt, which really destroys everybody's morale and really is the root of the majority of the problems when you talk about relationships in this country. And all that's great, right? But what is this about? This is about getting out of debt. Why? So that we can have that cushy retirement. So if I'm saving my 3% and I've got $60,000 left over after I've made my $2 million in my lifetime, that's okay. Because I've got Social Security I can rely on, right? Because the federal government's got me, right? Well, what happens if I change that from where you are saving $60,000 to now you're saving $300,000? That's changing your savings account from 3% to 15%. That's a 12% increase, right? Nope. That's a 500% increase in the amount of money you save for retirement. And all the while, remember one of the first things I said, this is all designed without you paying any more money than you're paying right now. Okay, that's the goal, because you spend money inefficiently. And I'm going to show you that in just a minute. So let's move on. So how do we do it? So we're going to reduce the interest you pay to lenders. We already talked about that. We're going to eliminate the amount of interest you pay by over 40%. We're going to eliminate all of your debt 9 years or less. Really? No, that's 15 to 27 years early. We're going to reduce the amount of taxes you pay over time by 25%. Increase your cash flow. Why? Because I know, like I said a minute ago, if the program costs you money or it does not increase your cash flow, you're not going to stay with it. Okay. And then finally, I love that last bullet. Allow you to retire with a tax favored income. In my book, the most tax favored of all types of tax favored incomes is a tax exempt income. And that's what we're talking about here, tax exempt. Thank you, IRS tax code 7702A. All right. So there's lots of other programs out there that you've heard of. There's a method that uses a home equity line of credit method. There's velocity banking. Not advertising for these people, folks. They are bad ideas, just telling you. Okay. There's an Australian method. There's a sweeps method where they take money out of your checking account every night and they put it into your savings account and then move it back every morning. There's programs that are out there that use indexed universal life programs. Okay, we know what's happening with the market right now. Why in the world would you use an IUL for one of these programs without knowing where the market's going to be tomorrow or the next day or the next year or 5 years from now. The same problem exists when you're using the home equity line of credit method. Why would you do that? I don't know what the interest rate is going to be in 5 years. I don't know what the interest rate is going to be in 3 years, depending on which HELOC you get. They're bad ideas, people. And when I look at all those others, and I've researched all of them, and I've done the math on all of them, and you may or may not have been on one of those calls where I specifically gave you all the reasons why not to do them. They all fail for a reason. They all have an Achilles heel. And when the Debt-Free Life program was developed, we looked at that. We looked at all the reasons why those programs fail, and we put stop gaps in there to make it so this program doesn't fail. There is one reason why it fails, and I'll tell you that later, but there's only one reason. And the biggest thing that we saw is that all those programs do not plan for the unexpected. What's the unexpected? Maybe something happens to you and you can't work for 2 years. Maybe you're a part of a 2-family earning household and one of you can't make money anymore. Maybe one of you becomes incapacitated. Maybe one of you passes early. All those problems exist, and those other programs do not plan for that. So what we do is we do plan for that. How? All the money that goes into this program is available to you. 20% of it is held in reserve. It is there. It is earning money for you. It is earning interest for you, but you cannot touch it. And if you do touch it, it's got to be a real emergency. It's not a, I need to take a trip to Tahiti emergency, or I need a new jet ski emergency. It's a, holy cow, my daughter just got XYZ problem. She can't work anymore. I need to quit working and go take care of my daughter for the next 2 years. It's a real emergency, okay? Because if you actually execute this and access that emergency fund, you're actually closing down your program. That's what it's there. You can use it, but you only got one shot. So let's move on. When we compare these programs to traditional, now we're talking about investment vehicles. When we compare these programs to traditional investment vehicles, IRAs, Roth IRAs, savings accounts, traditional ways that people save money, CDs, bond funds, put it in the market, buy real estate, all those have their issues with them. And the main issue with most of them is you do not know what the return's going to be. And most of them, if they're banking instruments, they are not tax exempt. They're either tax deferred. So, well, what about real estate, Scott? I bought real estate. That's great. When you sell that real estate, are you going to owe tax? Yes. How much tax are you going to owe? Depends on how long you owed the real estate. Owned it for 2 years, more than 2 years, and you got long-term capital gains tax. Owned it for less than 2 years, you got short-term capital gains tax. But I sold it for 40% more. Yep, that went right to your taxes. You didn't make a dime. Okay, so all those other vehicles, they've got major problems with them. And most of the problems are subject to the fact or suspect to the fact that you do not control their growth. You cannot control their growth. You are relying on the market and things that are beyond your control to get you to where you want to be. So when we look at just 3 basic solutions, that's what you see on the screen right here, taking into consideration a standard $10,000 investment, leaving it in your program, whatever your program is, for 28 years across the board, assuming a 7% interest rate, which doesn't happen, by the way, okay? In the history of the stock market, you don't see that over 28 years. And then finally, assuming a 25% tax rate. Really, it's going to be between 22 and 32% for most Americans. That's where that's where we're using those numbers. That's in the middle, a little bit less than middle. So if I'm using a taxed account, that would be a savings program with the interest that's afforded to me with most savings programs. I'm going to have $41,000 after all those years have passed. If I'm using a tax deferred account, ring that bell for your 401k. Yay, 401ks are great. No, they are not great. It's a joke. And now the illusion of a 401k is becoming apparent to all of us. That's what happens with a 401k, the tax deferred, the same $10,000 investment. And that assumes something that's happened in the market over the last 28 years that has never happened in the history of the market. Okay. And then finally, the tax-free method. The tax-free method is simply this. I pay my tax on the money I use to invest upfront so that I'm not growing the tax exposure like you do in a 401k or a TSP or a FERS or a KEO or SEP or any of those. And instead of me paying the tax and growing the tax, the only growth I'm having is the growth of the principal, which I do not have to pay tax on, because if I'm using a tax-free program, as a retirement program, like these DFL programs are, then even when I pull the money out, even on the growth, I don't owe tax. Okay. A lot of you should be having holy cow moments. This is too good to be true. What are you saying? Well, let's find out. This is a financial tool. All financial tools, financial instruments work the same way. They all start off with a maximization phase. In this case, our maximization phase is determined by the length of time it takes you to get out of debt. Our maximization phase is determined by the length of time it takes you to get out of debt. So then once we're out of debt, that means we have reached the pinnacle of the amount of money that we're putting into our program. And by the way, remember I said in the very beginning, we're not creating a bill for you here. All we're doing is changing the way you spend money. We're spending it more efficiently. Okay. So all I'm saying is you're spending $2,000 a month on debt service right now. Great. We're going to spend $2,000 a month on debt service. It's just, we're going to capture 70% of it as cash value as we move forward in time. And we're going to use that as an investment tool. Accumulation. You have reached the pinnacle of what you want to contribute. You have eliminated all of your debt. You can be the most efficient with that money that you were spending inefficiently. You can be the most efficient now, and you're making probably at that point 75 to 95% of your money work for you for the rest of your life until you're ready to do the distribution phase. That is the time, Tom Deutsch, when you can decide to take that emergency trip to Tahiti or buy that jet ski. It's the distribution time. It's time to have fun. Do whatever you want to do with your money. And guess who makes the decision of what you get to do with your money? You do. You're the bank, you're the banker, you're the controller of the program, whatever. Wait a minute. What's my cost of money? Well, actually, in most cases, your net cost of money is going to be 0.8%. But if you structure it correctly, your net cost of money is actually going to be a gain. We'll talk about that in just a minute. You're still going to be able to use your money. You're going to get positive arbitrage, and you're still going to be able to use your money and then use somebody else's money and still use your money and use somebody else's money and still use your money. Too good to be true, right? Stay tuned. All right. This is not new. When we look at those other programs, and I do call them fads, the infinite banking concept by Nelson Nash, in order to execute his program, you've got to read a 260-page book, most of which is math, and you have to understand the math and you have to apply the math. Most people can't do it. You look at that stuff by the gentleman I mentioned earlier, whose name I will not mention anymore. His stuff is predicated upon programs that fail by default. Look at that home equity line of credit method. We already shot holes in that. You look at that sweeps method. It's a whole lot of software expense for a whole little amount of income. It's not worth it. Do you think that people on your screen know something maybe that we don't, as standard blue collar Americans, don't know? All these people that you see have executed these programs in the past. The one that we're talking about tonight, this is the original. This is the one that was originally done by John Rockefeller back in 1904. And then shortly followed by the Woolworths, J.C. Penney, J.P. Morgan Chase, every oil baron, railroad baron, steel magnate, every high wealth individual in the U.S. from 1904 to now, even to this day. Warren Buffett still does these programs to this day. There's a reason. And there's a reason why the wealthiest segment of the population use this program over and over and over consistently. And it has everything to do with tax elimination, tax sheltering, and growth that we don't have to pay tax on. We already talked about this just to a limited degree. This is nothing new. There's one thing at one point I do want to make here though. When we're looking at these programs, debt it's a linear or circular event depending on how you look at it. So if I owe $10,000 2 months from now, but I don't owe $10,000 today, I know that I'm going to owe $10,000 because I know in 2 months I'm going to buy a new car. Okay. There's nothing that says I can't start paying that debt now. So that's a key thing here, financing future purchases. I can start. One of my clients did this. He has a very expensive car, and the tires for his car cost $1,600 each. Okay. So he knew he was going to need to get new tires in 12 months. So he created a bill for himself that he simply paid that money into his program, $1,600 times 4. So $6,400 over a period of 12 months, so that when he got to that time, there was money in the program. All he did was take the money out and go buy the tires. Painless. right? Financing future purchases. If I'm a 1099 and I know that I'm going to be paying taxes on the income that I make, would I consider paying my taxes a future purchase? Just a thought, right? So I can put all my taxes into this program and make my taxes work for me for the rest of my life. Okay, this is where you're just a little bit outside the box thinking, right? When we first started this program back in 2018, 2019, these were some of the first families that we helped. The numbers that they're showing there, 100,000 in seven years, 73,000 in 5 years. Those are average pedestrian numbers. Those are, from what I see, those are way small versus what I'm usually using now. I'm looking at 500, 700, 2 million, 5 million of debt that we're getting rid of, and we're getting it rid of in the same time. Here's the little dirty little secret about these program folks. The amount of debt that you have is irrelevant. It doesn't matter. As long as you're able to make your debt service, as long as you're paying your debts off. And the only thing that influences the rate at which you're going to pay your debt off is the number of debts you have. If I've got two people side by side, one has one debt that's $100,000 mortgage, and one has 5 debts, of which there's an $80,000 mortgage and 4 credit cards, same amount of debt, but the person with 5 debts is going to pay his debt off about twice as fast as the person with 1 debt. And that's the effect of the debt snowball. Remember, 2 financial instruments: debt snowball, infinite bank, private bank, same thing. Okay. Before you understand how the program works, you have to understand how you spend money. Okay, so let's talk about that for a second, Carrie Stone King. How do you spend money? So right now you make money. That money comes to you via whatever methodology you use to earn money, whether it's whether you're a 1099, a W-2, W-4, whether you're receiving royalties on a book that you wrote, it doesn't matter. You make the money. You do the same thing with the money that everybody else does. You deposit it into your checking account, your current bank, if you will, your Wells Fargo, Citibank, Bank of America, doesn't matter who it is. And then what does the bank do? The bank makes money with your money every night. The bank actually lends your money out 7 times before you actually touch that money. They make money with your money. The average dollar you put in the bank is lent out 7 times and earns that bank 61 cents. Do you ever wonder why every bank you walk into is mahogany everything and marble everything, and there's lots and lots of people working way more than they actually need? Where do they get their money? They get it through a process called positive arbitrage, which means they're borrowing money from you at a lesser interest rate than they're lending it out. What does that mean? They're borrowing it from you at 0%, Tom Deutsch. And then they're using it every night, and they're making anywhere between 1.8% and 24% with your money every night. And they're not giving you a penny for it. As a matter of fact, the concession they'll make is, hey, thank you for keeping all your money in our bank, Mr. Forehand. We really appreciate it. And thanks for letting us use it. And because you're doing that, we're not going to charge you money to keep your money in my bank. Okay. So I don't know about you. I'm not happy about that. So let's finish this up. Now what happens? So the money's sitting in the bank, and you tell the bank, hey, go pay my debt, pay my car payment, pay my credit card off, pay my house payment. And then what happened? Your money is now their money. And if you are the nicest guy in the world, like Tom Deutsch, and you are super, super sweet, and you ask them, hey, Mr. Creditor, I know we paid you, but I really need that money back. Can I have the money back? Their answer is going to be, the short answer is going to be no. The long answer is going to be hell no. Okay. They're not going to give you your money back. Your money is gone. And in that process, you had your money, X, sit in the bank, make X times 61% for the bank, and then you transferred it to your creditor for X reduced amount of debt. What's your gain? 0. As a matter of fact, if what you were doing was buying a depreciable asset like a car, your gain is actually a loss. Okay. So this is how we are taught to spend money. This is how we are taught to get into debt. This is how we are taught to fund the banks. And this is the key problem with that, with where we are right now. And this is what the Debt-Free Life program fixes. How does it fix it? I'm glad you asked. Here we go. Same process. You make money the same way you make it right now. It gets deposited the same way. It goes into your checking account. Doesn't matter who your bank is with. Here's where things change. So instead of letting the money go into and sit in my bank account and let my bank use that money over and over and over again, I'm going to put it into my private bank. I'm going to put it into my infinite bank. I'm going to do the same thing John Rockefeller did back in 1904, except the words private bank and infinite bank had not been coined at that time. He simply called it life insurance. So we are using life insurance as a vessel to store and grow cash. But it's not just any kind of life insurance. It's a specialized type of life insurance called participating whole life. And that word participating is critical here. The word participating means that by me giving my money to a life insurance company, which are the most profitable companies on the planet, ding, 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 by me giving my money to a life insurance company, I am able to participate with their profits because I'm buying a participating whole life policy. Okay. Now, does that mean I get a lot of their profit? No. But I get to participate with the most profitable companies on the planet. What about Apple? What about IBM? What about Google? Yeah. Were they around 100 years ago? Do you think they're going to be around 100 years from now? My guess, your guess is as good as mine. But I know the insurance companies were there, and I know they're going to be there in 100 years. So now, why are we using whole life, participating whole life? I gave you the first part of the answer is because we get to participate with the profits, which means we're going to get some pretty solid growth. The second reason why, we're going to add a term life rider, and this is so that we can take advantage of IRS tax code 7702A, which says all money derived from a life insurance policy is tax exempt. It also says, as long as the life insurance value exceeds the cash value of the program, that the program is still life insurance. The minute we pass that speed limit where we go over, where we've got more cash in there than life insurance, that policy is no longer considered life insurance. It is now considered a modified endowment contract. As a modified endowment contract, we are now subject to banking law. We are also taxable. So finally, third part, paid up additions. So this is not three separate life insurance policies, folks. This is one policy. It's a whole life policy. One policy with two riders. Term life, so we can create that massive umbrella of life insurance because it's cheap. Term is cheap. We want a term life rider so that the IRS cannot touch, tax, or see how much cash we have growing in this thing. And then we want paid up additions. Why? So paid up additions, it's like having cash. So if you look at banks like Wells Fargo, Citibank, Bank of America, they are required by banking law to maintain an amount of assets that are going to equal to their obligations. If they lend out $100,000, they have to have $100,000 to be able to do it with. So the way that most of those companies have assets structured is tier 1, 2, 3, and 4. Each tier is more risky than the next tier. Tier 4 would be something like lending money to a 20-year-old who had a paper route who wants to go open a restaurant and giving them $1 million. That's an extremely risky loan. They don't do a lot of them. I don't know if they ever do any of them, but that's a tier 4 asset, which is most likely going to fail. A tier 1 asset, that's the most secure, most safe kind of asset. That would be something like gold. That would be something like an A+ or an A++ rated municipal bond. That's a pretty solid asset. In this case, it is the most solid of all tier 1 assets. Why? Because it's life insurance. And so let me explain that. So if I buy $1,000 worth of life insurance today and I pay it up and I give them $1,000 and they give me $1,000 of death benefit, tomorrow, how much is that worth? $1,000. 10 years from now, how much of it's worth? $1,000. When I die, how much is it worth? $1,000. Will it ever lose value? No. Does it cost anybody anything to maintain its value? No. Well, Scott, I can just buy gold. Great. How much is gold being worth tomorrow? You ever seen gold go down in value? Of course you have, right? So This is a viable, tangible asset that will never lose value. The banks recognize that. And just to illustrate that point, Wells Fargo has $28 billion as tier one assets, structured tier one assets that are life insurance policies, bank owned life insurance. You ever heard those commercials? If you've got a life insurance policy worth $100,000 or more, don't close it out. Call us. We might buy it from you. It might be worth something. Yeah. What's it worth? Well, it's got $10,000 of cash value. We'll give you $1,000 for it right now. You're 74 years old. You're probably going to die in 10 years. Yeah, we're going to make 10 years. Oh yeah, we'll give you $600 for it. That's what that is. Bank-owned life insurance. Viatical settlement companies. That's how they make their money. That's all they do. And their number one clients are banks. So we just established, what are we doing? We're using whole life as a vessel or a vehicle to store and grow cash. We're using a term life rider on that whole life policy to create that umbrella so that the IRS can't see it, touch it, or tax it. And we're using paid up additions as, get this, collateral. What does that mean? In the process of moving the money up into our life insurance policy, we took that revolving growth circle away from the bank and put it on our private bank. We created a private bank, which we're going to call a DFL bank. How do I get my money out of the bank? I told you earlier that 20% emergency fund, that's cash. If you touch that, you're closing the program down. So that's not the way to address, that's not the way to get money out of your program on a regular basis. So what do? The paid up additions, of which normal structures of these programs, about 70% of every premium payment you do is buying paid up additions. The carrier considers paid up additions as cash. The carrier considers paid up additions as cash. So when the carrier looks at how much money you've got in your program to apply your 3, 4, or 5% interest, or looks at how much money you've got in your program to apply your 1, 2, 3, 4, 5, 6, 7, or 8% dividend, they're looking at how much paid up additions you have. So the way these things work, remember that term life umbrella? As your paid up additions grows, and the life insurance value in the paid up additions grows, eventually you don't need the term life rider anymore because you're in life insurance, but the carrier considers it as cash. So that's your growth vehicle. So if I've got $10,000 in my program as paid up additions, and I've got a credit card with a $6,000 balance, the first thing I'm going to do is I'm going to take that money out and I'm going to pay off that credit card. If I do it the way I just said, then I'm taking cash out, my cash out, principal out, and I'm paying off my credit card, which means I traded X for X. I've got zero gain. What happens if I take a loan? The carrier does not have a problem giving you a loan because the carrier already has your money. It's like having a CD on file with the bank, except for where the bank's going to charge you 4% interest to borrow your own money that you're earning 1.2% interest on, and make that 2.8% delta. That's not here. Your net cost of this loan is going to be 0.8%. Depending on which carrier you use, that's engineerable so that it's not 0.8%, that you're still getting a gain with it even after the fact. So what do? I tell the carrier, hey, I need a $6,000 loan. And the carrier says, no problem. And they deposit the money right into your checking account. Then you say, hey, Mr. Bank, no, I'm not leaving the $6,000 in there so you can lend it out 7 times. I want you to send it right now to my creditor and pay my debt. So in that scenario, what did I do with my money, Tom Deutsch? My money is still sitting in my bank. It's in my private bank, earning interest, earning a dividend for the rest of my life. Is my debt paid? Yes. Does the creditor care where the money came from? They do not. All they want to do is get paid. What's my gain? My debt is paid and I've got my cash. My gain is 100%. But wait, I've got a loan. Yep, you do. I've got a loan against something that's already been collateralized. Yep, that's true. Don't I have to pay back my loan? Maybe, if you want to. You're the banker. Are you going to sue yourself if you don't pay yourself back? I don't know, right? So the point is that these programs are structured, and the access to the cash in your program, which in this case, most of which is going to be paid up additions, the access to that is limited by the carrier to 95% of the value. And I'm going to tell you, don't ever encumber more than 90% of the value. If you encumber more than 90%, you run the risk of the program potentially failing sometime if something crazy happens to you and you stop making payments. But if you keep the balance, the loaned amount less than 90%, then you will never be able to make the program fail. All right, I want to do one example and then we're going to stop because I want to do an illustration tonight. All right, so this is what it looks like for a family that I worked with a couple of years ago. And most of you that have been on this before have seen this before. I promise at some point I'll take time and get new material. So this is from 2019. I just met with this family for their 2.5-year review, and they are right on track. So this is where this family was. It was a blended family. 2 families had both been married before. There was actually 3 properties involved. Both the husband and the wife had a personal residence prior to this, and they bought a new house together. The wife was a PhD student, and this may hit home for our special guest tonight. A PhD student with over $108,000 of student loan debt. She is now teaching at William and Mary, slowly paying down that student loan debt. Oh, by the way, I said this before, I'll say it again, student loans are evil, okay? So looking at this, they were on track to be out of debt in 40 years. Anybody know why? It's because that student loan was in deferment. And as it's in deferment, doesn't mean it's not growing, it's growing, yep. Then student loans are evil. So it's going to take this family 40 years to get out of debt. Was it really 40 years? Yeah. Was it really $585,000 of the debt? No. It was actually $767,000 once you looked at what the scheduled interest was going to be. That's their true debt, $767,000. This is what we did for them, 7.8 years. They are now 2.8 years into the program. They are here. They just paid off their other car. So now all that's left is a student loan and 2 properties. They're on track. They're working it just like the way we taught them to. So to go from 40 years to 7.8 years is massive. Remember what I said in the beginning, it's 15 to 27 years early. Yeah, well, in this case, it's more than 27 years. It's 32 years early. It's pretty strong. Okay. More importantly, when we look at this, the gentleman that I did this program on was 36 years old at the time. He owned a trucking company. He owned his own rig. He was in the process of scheduling out and planning how to buy a new rig every 2 to 3 years. Our program has allowed him to buy a new rig every year. And he now has 3. So he has 3 rigs, of which he drives 1. He's got 2 hired drivers to do the other thing. He's using this not only as a personal DFL to get rid of all of his debt, but he's also using this as a business DFL to help him grow his business. And where his business model was originally to spend the next 12 years getting up to 4 trucks, he'll be at 4 trucks in 4 years. It's massively different when you're actually leveraging this debt, leveraging the wealth. We're not doing anything different than he was already spending. We're not creating a new debt for him. We're not doing anything other than spending money in a more efficient manner so that we're capturing and being able to eliminate his debt. This is how the program worked. Every one of those yellow bars is a year in which he paid off, he's going to pay off 1 or more debts. We are already here. By the end of this year, he will have 91, all those debts, previous debts are paid off other than his mortgages and the student loans. And he'll have $91,000 cash in the program. What he's going to do at that point is he's going to start mortgage chunking. And if you've seen any of my other videos, you can go back to look at it. Mortgage chunking is a great tool. So he wanted to retire at age 75. I said, okay, we can get you to age 75. You'll have $5 million at age 75. But what if you don't want to stay that long? What if we get you retired at age 55? You'll have $1.5 million in the program at age 55. Take out the $32,000 at age 56, it's $1.64 million. That's $130,000 growth in 1 year minus the 32. That's about $98,000. So he's making, without spending any more money, just organic growth with the guaranteed interest rate plus the dividend, he's making $98,000 a year tax-free at age 55. I think most people would be able to retire with that. That's the equivalent of $160,000 standard income at a normal tax rate. I think you'll back me up on that, right, Randall? So there you go. So this is how these programs work. So what about if the person doesn't have a mortgage? What about if they're just starting off on life? So I'm going to stop for a second. We'll let you guys ask me some questions if you have any. So here we go. If you got a question, don't be shy, unmute yourself and ask away. Oh, we have royalty with us today, everybody. Winifred Brown and Javon Spencer are both here.
I have a question.
All right, go ahead, Marcella. Nice to see you.
Oh, sorry.
Maricela Looper, go ahead.
Okay, hi, thank you, Scott. My question is, when do they sometimes ask one day pay the rest of the mortgage, right, with the cash value, and that take a few more years for them to go back to have the cash value? So take a few years to pay that they backed into the program. Sometimes they ask, well, I really don't get out of debt when I pay the mortgage, I get out of debt when I finish paying back to the program. You see,
So, I understand what you're asking. So what I would say is two things. Number one, nobody's got a crystal ball that works. So you don't know how they're going to fund this. You don't know if they're ever going to be short on a payment. You don't know if they're going to overfund at any time. So I would say this is just a projection. And this should never be considered to be the gospel. This is just a projection. And if they decide that they want to stop paying, if they've borrowed the money and they've paid off the debt, they can close the program. They don't have to pay back the loan. You know, if they have enough money in the program to borrow the money to begin with, they don't have to pay it back. The program will fail if you borrow 95%, which is what the carrier will allow, and you do not pay back the loan and you stop paying the premiums. The program will fail. Okay, that's why I say don't ever encumber more than 90% of the cash value of the program, because if you do that, the overage that you're getting from the complete guaranteed interest rate on the total amount and the dividend portion will be enough to pay the debt service on that loan. Okay.
Okay, thank you.
Yep. Anybody else? Oh, look.
Yeah, I just had a question about the presentation itself, the slides and such.
Yep.
Are there any of those slides available for presentation?
A lot of those are available on Symmetry. A lot of those are available through the Debt Free Life website. You can use them. Those are what's approved by Symmetry. Some of the stuff that I use, especially when I'm talking about how the money moves and all that stuff, that's proprietary. So
Sure.
I spent a lot of money having that developed for me because I am not an artist guy and I don't know how to do technology. So somebody else to do that for me, and feel free.
So they're on the Debt Free Life site,
Yep.
separate from Quility.
Yep.
Okay, thank you.
Yep. Very good. Anybody else? Somebody wake up Jamon.
Yeah, Scott, I'm trying to reach out to some business owners that I know, and some of them are going to have hopefully some referrals that maybe even be some cold calls. And I just would like to have a better way of just kind of communicating, just kind of like a statement or two to kind of get me in the door. What would you suggest that I say to somebody that I'm calling? Maybe I've got a business card that somebody's handed me to get in the door to talk about that.
That depends on their business. Depends on what they do. You know, is it a retail store?
I have a whole bunch of different ones.
Right,
They're all
so
over the place. Yeah.
You know, I don't have a magic bullet for that'll fit every business.
Sure.
It's always going to be catered to their business. Hey, Mr. Contractor, you're flipping houses? Great. Would you like to flip one house and never have to borrow money again? Let's have a talk. Hey, Mr. Retail Store owner, do you like paying payroll? How would you like to capture that payroll as a retirement income stream for you for the rest of your life? You know, it just depends on the nature of their business. You have to figure out what their pain point is and then use that. Okay. Hey, Mr. 1099, do you like paying taxes? How about we make your taxes work for you for the rest of your life?
Simple. Okay, great. Thanks.
Yep.
Okay, great. Thanks. Yep.
I have a question.
Hey, Javon, go ahead.
Hey, Javon, go ahead.
I just definitely, like how you put I do it all the time, but the way you put that, you have to have more life insurance than cash value, because what's happening right now is a lot of this is becoming more popular. So you have a lot of celebrities starting to talk about it, but they're only telling the in and out of the policy. They're only telling I want to be my own bank, and forgetting the part that you need insurance. So people are really thinking that they can empty out 50 grand and just go dump it in a life insurance policy and it's all going to fit. So I usually struggle a little bit with giving the reason why you have to have it built properly. But your reasoning was really good. Like, you have to have more life insurance than cash value at any given time of the policy, or it'll be a
Mac, right? So
Yeah.
in that scenario, if you've got someone with a large sum of money and they don't want a regular monthly payment, you can structure these as 2-pay programs with one of the carriers. You can do that. And the other thing you can do is a single premium whole life, which it doesn't work like a DFL because you can't add PUA, but you do get immediate access to most of the money. And you get a large death benefit. It's usually somewhere between 1 and 3 times, 1.5 and 3 times the cash value. So if you put in $50,000, you're going to get $150,000 of death benefit, maybe as much as $300,000 in death benefit on a single premium whole life program. And they'll have access to the cash immediately.
Are you able to do that without necking the contract?
No, it automatically necks. Yep. All right. Thanks, Javon. Anybody else? Okay.
I had a quick question, if that's okay.
Okay, who's that?
My name's Gallo. Sorry, I don't have camera right now. I'm on the road.
Okay.
You dropped you mentioned young investors or people first starting out in life. How young? And 2, is this something that I'm assuming you don't recommend exclusively just throwing all their money into this, that they still continue with other forms of investment to diversify?
Okay, so if you are a fiduciary, hold on one second. There we go. If you are a fiduciary and you have a Series 6, 63, or 7 license, you are not able to tell them to put all their money in one program. You are violating your training. If you are a life and health agent, you can, okay, and I do. And the reason why I say that is all other programs can be derived from this program if you want it to. So you're not tying up all your money. You're putting it someplace that's safe, where you're going to get a guaranteed growth rate, where you're going to get a guaranteed interest rate, where you're going to get a guaranteed dividend for the most part. You can't say you guarantee the dividend because nobody can, but one of our carriers has paid a dividend every year they've been in business since 1904. I'm just saying. Okay. So you can't do that, but you could, and this is something we talk about in some of our advanced discussions, you can do annuity stacks out of these. And so by that, you're doing an automatic diversification. You're taking money out of your DFL program, putting it back into your bank account, letting it commingle for a little while, so you can't see whether the funds came from income or came from a loan from your DFL account, and then take that $10,000 and throw it up and buy an annuity. And now you've created the same money in 2 different places. Both of them are earning for you at the same time. So there's lots of things you can do with this. Okay, it's not one size fits all. There's so much stuff that's here, and again, no 2 people are the same, right? Everybody's different. I see you smiling, Betsy.
Got it.
I saw you nodding. Does that help you, Gallo?
Thank you.
Gallo?
Yes, it does. Thank you. Good answer. Thank you,
Okay,
sir.
and the answer is 18. 18 years old to start one of these programs. All right.
So Scott, can you show us what a program looks like for a
Not tonight.
single premium
Nope.
policy?
Debt-free life. I'm not doing single premiums tonight. All right.
Okay,
Sorry, Vicky.
that's all right.
I can tell you
I'll
that
catch you later.
Yep. The application for a single premium whole life is only 10 pages long as opposed to 25 for the DFLs. So it's a much faster application process.
All
Okay.
right, I'll catch you later.
All
Thank
right.
you.
Yep. All right. So,
Scott, this is Marissa. I'm very
Hey.
new to this, but it all sounds extremely interesting. Do you have any case studies that we could take a look at, or I could take a look at, that could probably help me understand a little more? I know it's very, okay, Tom has. Great. Thank you, Tom.
okay. Thanks, Tom. All right. Anybody else? All right. So now, Faith. Hi, Faith.
Hey, Scott.
How you doing?
Doing good. How about you?
I'm fantastic. So for the next 20 minutes or so, we're gonna actually do a live process on Faith. So Faith, thank you for being our guinea pig and allowing me to ask these questions that I'm getting ready to ask you. So the first thing we're gonna do is I'm gonna close that PowerPoint down. Yeah, get rid of that one, get rid of that one, get rid of that one. All right, next thing I'm gonna do, close that down. I've got way too much stuff. Yeah, you guys ever done a Zoom channel with one of your clients and you see like 50 things open and he's like, how the heck do you get through all that? Yeah, that's not me. I can keep like one or two things open because my brain is that small. So what I'm going to do is I'm going to show you, and everybody, it's no secret who my favorite carrier is, right? Everybody knows. All right, so we're going to go ahead. I'm going to do an illustration using my favorite carrier. And Faith and I met earlier today, and we already started this process. And here is what we came up with. So Faith is a resident of Louisiana. So when I was structuring this program, everybody see my screen? Do you see the data entry part of my screen?
Yep.
Yep, very good. So this is Faith Simpson, date of birth, non-tobacco female. We looked at where Faith was spending money and how Faith was spending money. And we identified $200 that she was spending inefficiently. Okay. So just for the record, Faith is a college student. So her income level is not as high as some of the clients that we meet. So $200 is what we did. And I did a standard distribution, assuming $130 a month was going to go towards PUA, right? So this is a 70-30 program. All right, Betsy, my math right? Or 65-35, 65-35, 65-35. So this is a 65% efficient program.
Yes.
We got Faith retired at age 60. I'm doing a single 10-year term rider. Now this is going to renew automatically, but here's the kicker. That 10-year term rider, I'm asking for $2.5 million worth of term. Anybody know why? The whole reason why I ask for massive term programs is because I'm trying to get that as umbrella as big as possible. So I know for a fact that on a $200 a month program, there is no way they're going to give Faith $2.5 million of term coverage. I know that, but I'm going to ask for it anyway. And rather than going back and forth and trying to hunt and peck and guess at where the max amount is, they're going to automatically compute that for me and add it in. This is a super time saver when you're trying to get through these programs fast. There's one more key thing I want to make sure everybody sees. I scheduled the term to run 1 year after the whole life. Why? By default, there's no way this program can mech because I did that. No matter what, it cannot mech. Okay. So no matter what Faith wants to do, no matter how much money she wants to put in here, it cannot and will not mech. If she tries to put $50,000 in here 1 year and she can only hold 25, they'll take the 25, deposit it, and send her a check for the balance of what they can't hold. And then by putting this massive term in there, I'm going to get the maximum amount of PUA. So now when I run it with the mutual trust illustration, there's only 2 pages that you need to concern yourself with. Page number 2. Everybody see my page number 2? Can you see it?
We see it.
Great. So there's Faith's starting death benefit. There's $200 a month. $559 a year is going to pay for $33,000 of death benefit a whole life. $281 a year is going to pay for $332,000 of term. This is an optimal program. This is by default optimized on day one as soon as I plug these numbers in, unless I want to put more money into PUA. Okay. This yields $13,000 a year maximum PUA contribution. Not bad. Not bad for a, what do you face? 21, 22, something like that.
Totally.
There you go. The other page you need to look at is the last page of the illustration. Why? Right here. Do not order an exam. Telemed will be ordered by mutual trust. Guess what? This is a simplified issue, folks. Ding, ding, ding.
That's amazing.
Yeah, thank you. Thank you very much. Please sing it. I love your voice.
Oh my goodness. I didn't realize I was unmuted.
Yeah, you are muted. Welcome to the party. All right. So just
Scott,
yeah.
Scott, I thought that all of these were fully underwritten.
Oh no. No.
Yeah, is this new?
No. This started last year. Was originally $500,000 as the ceiling. They raised the ceiling this year to $1 million. So
But
if
now,
you're,
if they do telemed, can they still push it to fully underwritten?
one more time.
If they, like, if something happened, like something triggers in the medical report, do they push it to be fully underwritten?
Yes. Okay. So right now they're telling you don't order the paramed. All right. So if the person is between the age of 18 and 50 and the computed on back to page 2, the computed death benefit for the 10th year is less than $1 million, then it will become simplified issue. They're going to use MIB. They're going to use prescription drug history. They're going to use the information that you provide to them. They're going to pull driving record, driving history, police record, all that stuff, the same stuff that SBLI does, all that stuff, and they're going to make a decision. For
Okay.
these, I've seen them done in 3 days. Underwriting is complete in 3 days.
What?
Depending on, yeah. Okay. Yes. Yeah. Hey, Betsy, welcome to be unmuted. Okay.
Yeah.
All right.
Beforehand, you taught me something here. I came for a lot of stuff, but you didn't quite say that part.
Okay, can you say that? So you're saying, and I'm saying, you put this here, that a DFL was approved in less than a week?
Listen, I submitted one Sunday night. I submitted Sunday night and they called and did the telemed on Monday morning. Before I could even check it on the website, the telemed was completed and they approved it yesterday. So the week before I did one and it was 5 business days. This e-app with MTL is so fast.
It's lightning fast. Yep.
All
Okay.
right. Thank you, Forehand.
And we're not done yet. Stick around.
Oh,
All right. So this is the information that we gather from the illustration. I'm telling you, there's 2 pages you got to pay attention to. If you're brand new to MTL's illustration, the other piece that you want to probably look at is this modified endowment contract. The contract will become a MEC at age 34. However, do not pay attention to that. See the words basic illustration? Go to where it says supplemental. Based on the premiums, dividends, and death benefits as illustrated, this policy complies with section 7702A of the Internal Revenue Code so that it will not be a modified endowment contract. So when you're looking at these things, make sure you're paying attention to the right one. If there's a supplemental, the supplemental is going to trump the basic. Okay. All right. So now,
Scott,
yep.
Scott,
Hey,
what if the supplemental does not agree that with what it's saying now? What if it's the opposite? Where you make the adjustment in the application?
The supplemental is always going to be the correct one. If the supplemental says it's going to MEC, then it's going to MEC. If the supplemental says it's not going to MEC, it's not going to MEC.
But if it's going to MEC and you don't want that
Then what
to
do you
happen,
do? Okay, then you come back in here. So here you go. So let's say I want to show Winnie. If I screw up, so I have the term policy cutting off at age 50 now. When I run this, come on. Now there's no supplemental.
you want the supplemental.
You want, and now there's still a supplemental, but now 23 years. So now the basic illustration says it's going to mech in 23 years, and the supplemental says it's going to mech in 23 years. So then you have to do the why. Well, the only reason that's going to happen is because you don't have the term running longer than the core policy. Core policy is over at age 60. So I need to be 1 year longer than that. And then boom, supplemental is now going to be accurate, and it's going to say that it won't mech.
That's awesome. Thank you.
Okay. All right. Any other questions before I move on to the next phase? Right on. All right. So I'm going to stop with this one. Okay. And now we're going to go here. So Faith and I talked earlier about her debt and the different debts that she had. And the debts that she have are primarily because she's a doctoral student. The primary debts that she had are based on student loans and a couple of credit cards that she keeps around. So when I'm looking at doing, there's no mortgage debt. She doesn't have a mortgage, she doesn't own one yet. Doesn't have any investments yet. Her income sources are income. She doesn't make very much money. She doesn't have any insurance policies where we can recapture debt that's spent inefficiently. Oh, by the way, I did that yesterday, 2 days ago with a client. I replaced 3 policies, collected over $100,000 of whole life cash value transferred into this. And that family is getting completely out of debt as soon as these policies goes live. They're taking the cash value out of their DFL program and a single premium whole life, because we did both. And they're eliminating, they have a $9,000 loan, personal loan, and $100,000 in debt on their house, and they're going to be done in one day. Where Faith has a problem is these student loans. And I've said it before, and I'll say it again, student loans are evil. So we're looking at a 10% interest rate on the student loans. The minimum payment on these loans right now is $425. Now, Faith and I talked, and this is actually in deferment. It's what we're going to show here is much worse than what is the reality is actually worse than what we're seeing here. Okay. Sorry, Faith. Here's a little dose of reality. And then we've got credit cards. We're just using the credit cards to be able to illustrate the true value of the debt snowball. So when we go through this process and we plug in that illustration that we just ran, which I've already uploaded, this is where we're at. We have a total of a $200 a month program. That's it. Folks, I've done these for as little as $85 a month. You do not have to spend a lot of money to make these programs work, especially the younger and the healthier the people are. Okay. There's one more thing to consider. What about if it's the reverse? What about if they're not younger and healthy, but they're older and unhealthy? Great. Why? Because that makes them get tabled. Okay. Mutual Trust just changed their tabling. They'll now write PUA up to table 5. They'll actually write table 6, PUA up to table 6 if the person's under 50. You should have just, if you're writing these programs and you know what you're doing, you should have just had an aha moment. Okay. So if you write someone who's a table 6,
Amazing.
yeah, that's massive, right? If you're writing somebody who's on a table 6 and you did your illustration when they were on a table 1, that means you're going to have a 600% increase on the PUA capacity without changing anything, just tabling it. Now their death benefit is going to fall through the floor, but we don't do these for death benefit. We do these for banks, for private banks and infinite banks, right? Okay. So here we go. Faith, you ready? You excited, Faith?
I don't know. We'll see.
All right. Here we go. All right. So now I think I have to change over to this so you can see this. So we're all seeing this together for the first time. Sorry, Faith, but thank you for playing along. So there's a lot of gobbledygook. I've talked to Resma a couple of times. I wish this was actually accurate for each person rather than a default image for each person, because it would make more sense if that was the case. I don't know that he's going to do it. Amortization is great if you actually have something to be amortized. If you don't have a mortgage, this is this is pointless. Okay. $200 a month is all we're using. Here's your true debt, Faith. You're actually not in bad shape. You're $96,300 worth in debt. With your average.
I'll trade you, Faith.
Yeah, really, me too. Yeah. I put in this program at 21.6 years. I needed to demonstrate some longevity. The reality is way worse for you, because we talked about your student loans, and we know that some of them or most of them are in deferment right now. So we're actually not paying down this debt's growing, and you know that. I'm not telling you anything you don't know.
Until 2026.
There you go. So just by taking a real look at one of them, not all four of your student loans, just using one of them as a real loan, this is where you are. Okay. Didn't have to be. We can fix it. Ready? How's 7 years sound?
Fantastic. And who won that? Somebody guessed it.
7 years at $200 a month.
Keith wins.
There you go. Right on, Keith. Way to go, buddy. So here's where we look at this. And how's this system work? It's what we showed earlier in that initial illustration. It's because of the combination of two financial instruments working in conjunction with each other, not working individually. It's the compounding effect of a debt snowball compounded by the compounding effect of the infinite bank. So you got money coming in from all different directions. It's not just your $200 a month program. It's everything. It's the fact that you're going to pay off that little bitty credit card at $25 a month, and you're going to create a debt snowball of $25 a month. And then you're going to pay off another credit card at $55 a month. And now your debt snowball is 80. And then it goes up to 130. Obviously, we're paying off the credit cards first because those are the smallest pieces that we can pay off to create the debt snowball the fastest. Okay. So at that point, it's not just $200 a month. At that point, it's 200 plus 295, of which, ding, 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 that 295 is 100% efficient. It is 100% cash growth. So you're starting off with a program that's 65% efficient. We're capturing $130 of every $200 payment. And then by the time you get to the snowball, where your last credit card is paid down to zero, you're adding in an additional almost $300 a month. So that means you're doing $430 a month, $425 a month at that point in time, that you're going to be able to massively and quickly eliminate your student loans. Did you have an aha moment?
It just feels like my student loans aren't going to hang around for forever, which is great.
Yeah, they're going to keep growing unless the administration decides to forgive everybody's student loans, in which case I'm going to sue because I didn't take out any student loans. I paid as I went, and I want that money back. So there you go. So that's where you are, Faith. Thank you for being a good sport. Thank you for allowing us to dive a little bit deeper into your finances. Do you think any of your other PhD students might be in similar positions that you are?
Most likely.
Yeah. Do you think any of them, if you came to them and said, hey, I can show you how to get rid of your student loans in 7 years for a couple $100 a month, you think any of them might be interested?
Potentially.
Yeah. Do you think maybe you should start offering these programs to them?
We've already talked about
There
this.
you go. Right. Okay. So these programs, you don't have to have a mortgage. It doesn't matter. Debt is debt. Okay. It doesn't matter what it is, other than of all the debts, student loans are the most evil, in my opinion. All right. So we're just about at that point, got about another 5-10 minutes. I'm going to shut up for a minute and let anybody else ask any questions, where you guys can discuss it amongst yourselves. I'll give you a topic. Chinese oolong tea, better than Lipton or no? There you go.
100% better than Lipton.
Of course. How much time did you spend in China, Betsy? Come on. Come on. Hey, do the Click Clicks have any coffee?
They have coffee? No, they drink tea too.
Okay. All right. There you go. Anybody have any questions? Winnie.
Scott,
Oh,
Scott.
everybody loves Winnie.
All right, so, all right, so
Come on,
this isn't my first rodeo in terms of
give me a
being
hard
on-
one.
on being on one of these presentations. Nothing is hard for
Come
you,
on.
Scott. So just to be clear,
Yeah.
all right. So with debt-free life,
Yep.
the concept is that once you pay off one debt, you still reinvest that same amount. That's the whole snowball scenario, right? You continue to invest that same amount. Then you accumulate and then you pay off the next debt. It keeps snowballing, but you continue to pay that same debt. So basically you're freezing the amount of what you owe right now in terms of output, your monthly payments, whatever that is, you're freezing that over a period of time so that the program, that's what makes the program efficient, right?
The debt snowball is what makes the program efficient. We like to start at a 70-30, 65-35, 68-32, 60-40. Okay, that's where we like to start them. There's a number of reasons why, we can talk about that offline, but that's how the base program should be started, somewhere in that range. And then the debt snowball is an increase in efficiency as with each growth, with each piece added to a debt snowball, because that's that 100% cash recognized payment, additional payment that you're making. And it's not just debt snowball. I mean, I talked to people the other night. Well, I get a tax refund coming up. Okay, well, how much are you getting? $4,000. What are you going to do with it? I'm going to go to a rodeo. What? Yeah, I'm going to go to a rodeo. Well, before you go to the rodeo, put the money in your DFL program and then take the money out and go to the rodeo. Why? Because you just captured the money forever. 100% cash recognized deposit working for you with a guaranteed interest rate plus a dividend every year for the rest of your life. So yeah, anything you can do, and this is another, it depends on the type of company you're using, whether it's direct loan recognition or non-direct, whether it's Foresters and Lafayette with non-direct loan recognition or MTL with direct loan recognition. There's a logical reason why you want to put the money in early with those, with MTL. It makes a big difference. It doesn't make a whole lot of difference with Foresters or Lafayette because of the way they recognize the loans.
So my follow-up to what I was asking. So do we agree that the snowball is what makes it efficient? Is that a yes?
Yeah. So yes. So but don't think, you know this too, Winnie. Like every program is unique for every client. Okay. So I've got clients that say, yeah, I'll throw $2,000 a month at it. It's like, great. We're not going to schedule that, but great. So then at that point, I know that they're going to be doing $2,000 a month. So at that point, I'm making as streamlined a policy as I can. And I'm not doing 2,000, I'm doing 300. And I'm making that $300 program have room to capture $1,700 a month additional snowball money every month. I'm not scheduling it, but I'm leaving the room. So at that point, I may not start off with a 65-35. It might start off with an 80-20. Or maybe it goes in reverse. Maybe it's a 40% PUA to 60% term and whole life.
I'm following you.
I know
so
you got that.
My question is this though. This is my next question. So oftentimes, of course, people who have debt, they very much so want to get rid of it, right? And the reason why they want to get rid of it is because they feel like they're going to get more money in their hands to use to do whatever with, right?
Sure.
Now, but this program sort of depends on freezing your debt and what you're paying right now, right?
Sure.
So at what point?
The way it's illustrated.
Say that again?
The way it is illustrated, it assumes that your debt service is going to stay the same. We're not creating a new bill. We're not making you spend any more money than you're spending right now, but we're going to make it so that you're capturing that money, even after you've paid that debt off. Because the logic is, okay, how'd you pay the debt off? You made payments on it and you borrowed money from yourself. So pay yourself back. That's why the debt snowball, that's the logic of why the debt snowball is coming back in. Because I'm repaying the money that I borrowed from myself.
I'll finish answering the question offline.
I'm sorry. I'm sorry, Winnie.
Can I interject something, Scott?
Of course. Tommy D, everyone. Tommy D.
Thanks, buddy. When I'm explaining this to my clients, a couple of things I put out there is, number one, it doesn't work for everybody. Okay, but the people it works for, it works phenomenally well for. And the kind of person we're looking for is, we're looking for someone who's not your typical American. You know, what's an American do when they've got a bunch of debts and they're making minimum payments and they pay one off? What do they do with that minimum payment? They go and they spend it on something else, which is fine if they want to do that. You know, it's a cost, or it's a quality of life thing. But we're looking for people that want to take that minimum payment that's already in their budget and invest it in their future, and invest it in something that's going to help them grow. So Winnie, I think what I thought I heard you saying is you were looking for what makes this efficient. And really what it is it's a lifestyle change. That people have to stop getting themselves back into debt, and instead taking something they've already budgeted, they're already making those minimum payments every month, and investing it in something that's going to do exactly what Scott was saying, and that's begin to build a nest egg that they never have to go into debt again. Does that help at all, Winnie, with the question that you were asking? Because I wasn't sure if that's what you were asking.
It does. All data helps. But but
Okay.
I kind of, it's okay. What you said is awesome, Tom. I get it. I got it, and I agree. So it's all good. But let me just say this, Scott. So if I come across somebody who's debt free, but let's say they own a new home, right? Would this program work for them?
Absolutely.
And all they have is the only debt they have is the home, though. They don't have-
Fantastic.
Oh, okay.
Yeah, so the presence or absence of any debt is irrelevant. In the presence of a debt, what you're doing is a debt-free life program. In the absence of any debt, what you're doing is an infinite bank.
Hey, Scott, could I just interject something?
Sure, William.
My son, we just did financial aid for him for his beginning this coming year of his third year of college. And last year I said, hey, you've been working, you're making too much money. We better do something with it. So we opened a debt-free life, account for him, stuck, some money inside there. He's making payments on it. It's all his own stuff. So he's entering his third year of college. He doesn't know how good he has it. He's living at home. He has no debt. He has money in a debt-free account. He's got Pell grants coming to pay for his education. He has 0 student loans, period. Dang, the kid's doing better than I am,
Right.
So, but we're getting in the right place, and I think it's so cool. And he doesn't even quite understand it yet, what's going on here. But we're going to keep it on the deal, and we made the right decision last year. Is the point?
Yeah, that's a common strategy with these programs, is when you've got parents who have children that are getting ready to go to college and they're trying to get grants and loans. You can take assets that are true observable assets, liquidate them, put them in a DFL program, so you still have the money, but it's no longer considered an asset. So it brings that qualification number down so you can actually qualify for those Pell grants and those student loans. Good stuff. All right.
I have a question. Can you cover the cash recognition, the difference between MTL versus Lafayette and Foresters, with the direct
Okay, sure.
Indirect and direct recognition,
Okay.
taking out the loans?
So the difference between direct loan recognition and non-direct is simply this. If you take out a loan and the company, Foresters, Lafayette, practices non-direct loan recognition, it doesn't affect anything. They don't care. Okay. That also means that their compounding is annually, and you can't get monthly compounding. Okay. That also means it doesn't affect the dividend. That also means that because you can't manipulate the system, you can't engineer positive arbitrage as easy. With MTL, they practice direct loan recognition. I'm going to pay you a guaranteed interest rate on all the money you got in the program. I'm going to compound it monthly. Okay. And I'm going to pay you a dividend on what portion you don't have encumbered over the course of the year. So if I have $10,000 in the program and I take a $9,000 loan, then I'm going to get my guaranteed interest rate on all $10,000 compounded monthly, and I'm going to get a dividend based on the $1,000. Now, where the difference comes in is where you can manipulate the program. So if I took out $9,000 and I had the entire year that $9,000 out, and I only had $1,000 where I'm getting the dividend, okay, then my cost on that loan is going to be 3.85% of the $9,000 for the full year. What happens if I actually structure that as smaller loans that get paid off just through the normal course of me paying my premiums? Okay, so if my premiums are $500 a month, and let's say I structured, instead of taking one $9,000 loan, which won't be paid off for 1.5 years, what happens if I took it as 9 $1,000 loans? And then in 2 months, I'm paying off the first $1,000 loan. Non-direct loan recognition companies will not do anything to you or for you if you pay the loan back. They're not going to return any unearned interest. They're going to charge you 1 year interest up front. Direct loan recognition companies will return unearned interest. And that's the critical part here when we're trying to get positive arbitrage. If I get 10/12ths of interest back on that first $1,000, and then 2 months later, I pay another one, and I get 8/12ths of interest back, and then 2 months later, I pay another one, and I get 6/12ths of interest back, and then 4/12ths, and then 2/12ths. That $5,000 that I paid back, I'm actually earning money. I'm getting my guaranteed interest rate, and now I'm getting a dividend, because when you pay the money back in less than a year, they pay you the full dividend. So in that case, I've got $5,000 of dividend that I'm getting. I'm earning interest on it 3%, and they've returned back at least half of the interest they took on that $5,000. So now what's my cost? My net cost initially on that $9,000 loan was 0.8%, 3% guaranteed interest, 3.8% charged. The net cost is 0.8%. If I do it, the loan, the way that I've just structured it, I'm going to get back more than half of what I earned. So now what's my net cost? My net cost is not a cost. I've engineered positive arbitrage. I'm getting back interest. I'm getting a larger portion of that 3% is actually sticking, and I'm not paying the prepaid interest. 5/12ths or 5/9 of the prepaid interest is coming back to me. So now I've got positive arbitrage. Does that help you?
It does. I guess I misunderstood the concept, and I thought when you borrowed from any of the lenders in the form of a loan, all you were doing was collateralizing it, but it essentially remained untouched. So you were earning interest on the entire amount.
Right. So for non-direct loan recognition companies, it does not, taking a loan does not affect the guaranteed interest rate. They're going to take 1 year of interest up front. You're going to pay that. And even if you pay that loan back the very next day, they're keeping all 1 year of interest. That's non-direct loan recognition. Okay? Direct loan recognition, I take the loan, they take 1 year of interest up front. I pay it back in 1 day, they're going to return 11/12ths of the interest. Direct versus not.
That's the big difference.
It's huge. Okay. Now, but also direct loan recognition companies, usually the guaranteed interest rate is slightly smaller, and the dividend is going to be is going to be slightly smaller also. But you can't engineer positive arbitrage with a non-direct loan recognition company other than playing with the premiums and how much money you're going to encumber. That's the only way you can engineer it that way. You don't have any control over how fast you pay back the loans.
I have a question to going back to the credit card. Do you recommend to the people that they constantly use their credit card, once you establish the program, that the new balance of the credit card is to be paid right on the time of the balance? In other ways, that debt will not be also increasing? You see what I'm saying?
So what I would say about credit cards is this: every single person is different. Every single person, some people have access to super high interest rate credit cards, and that's all they have. Some people have access to very low interest credit cards. I'm not a debt counselor. That's not my job here. I'm going to do the math as the DFL program allows. We'll have a discussion, But I try not to get too deep into the woods about which credit cards they should keep and use and which ones they shouldn't. As a general rule, I'm like, get the one that gives you the best points, keep that one. Don't cancel your other credit cards. Keep at least 3 active so it affects your credit score, but keep a 0 balance. If you put anything on your credit cards in any month, pay it all off. And that's the only advice I give on credit cards. Okay.
Scott.
Yep.
Scott,
Winnie.
yes or no? Debt-free life meetings with families are accomplished in 2 meetings, right? First, you meet with them because.
Yeah. Well, it depends on if you're Betsy Barr or not. Betsy Barr likes to do one-sit sales. I can't master that yet, you know, so it just depends.
You're an animal. Okay. I love it. All
Right on.
right, thanks, Scott. I
What's
got
it? Who's trying to do once it closes?
Oh, low blow, shots fired. I'm trying to do one set. Oh man. Oh, this is.
Well, I gotta bring my MTL illustration so I can write more once it closes with MTL. So that's my challenge for this next week.
Yeah. Well, there's some very cool stuff coming also. So, but anyway, all right, well, look, we're over time. All right, go ahead, Winnie. You got the last question. Go for it. Where'd she go? I guess she said bye-bye. Okay. Well, thanks everybody for coming. Hopefully you got something out of this. Have a great day. For those of you that are interested, there's a radio show on Saturday morning. You can call in from anywhere in the country. Just saying.
Thank
Okay. Bye, guys.
Peace.
you. Bye.